closing entries are prepared at the end of a company's year-end to ensure that the general ledger accounts are ready to begin the next fiscal year. Through the closing process, we keep some of the accounts and others have a zero balance. The accounts that we keep are called permanent accounts, and the ones that have zero balances are called temporary accounts. If you have a look at this adjusted trial balance, it contains a list of all of the accounts in the general ledger that have a balance. The permanent accounts, the ones that we keep to continue on into the next year, are the asset accounts, the liability accounts, and the capital account. So if you look at the assets, you'll remember that these are all of the things that the company owns, and it doesn't want to get rid of those to begin a new fiscal year. The liabilities are debts of the company, and although the company would like to get rid of them for the next fiscal year, they're not allowed. People expect to be paid. And the capital, remember, is the net worth of the company. That's the book value of the company, and that continues on into the future. Then we have temporary accounts. The temporary accounts are with the withdrawal account, the revenue account, and the expense account. All of these accounts are used to accumulate information for a 12-month period of time. After that 12 months is over, we want to start off with a zero balance for the next fiscal year. The closing process is a 4-step process, and we use the acronym READ to help us remember the steps to the closing process. The R in READ stands for revenues, so the first step is to close the revenue accounts to the income summary account. And I'll touch base on the income summary account in a moment, let you know what that is. The second step is the E in READ, is to close the expense accounts to the income summary account. The third step is to close that new account, the income summary account, to the owner's capital. And the last step, the D in READ, is to close the drawings account, or the withdrawal account, to the owner's capital. So we're going to have a look at the first step, and that is to close the revenue accounts to the income summary account. So if we look at our adjusted trial balance or our general ledger, we have 2 revenue accounts. We have a consulting revenue and rental revenue. When we close these accounts out to zero, we need to do the opposite of what's in the account already. So right now it has a credit balance. In order to make it zero, we have to debit this account for the exact same amount. So when we add the debits and credits together, we get a zero balance. We're going to do exactly the same thing to the revenue account. Right now it has a $300 credit balance. We're going to debit the account for $300 to make it zero. When we have a look at the journal entry, or prepare the journal entry, we would debit consulting revenue for the $5,850, and we're going to debit rental revenue for $300. And we know that when we create journal entries, we need debits and credits to balance. Our credit is to this new account called the income summary account, and we're going to credit the income summary account for the total of the debits. So that would be $6,150. So that credit would go in the income summary account. The income summary account is a temporary account that we use only in the closing process to help us calculate net income in the general ledger. Otherwise, there's no other place in the general ledger that would tell us that we had a net income or a net loss in a certain year. The explanation for our journal entries would be to close revenues. The next step is to close the expense accounts out to the income summary. You'll notice that the income summary account has $6,150 in it already, and that is from the first step when we closed out the revenue accounts. Now, if we have a look at the expense accounts, we're going to close all of these expense accounts out to zero in one journal entry. If you have a look at the insurance expense account right now, it has a $100 debit balance. In order to close it out to zero, we have to credit that for $100, and that'll make it zero. We're going to do the same thing to the rent expense account. It's got a $1,000 debit right now, so that means we're going to credit that account for $1,000 in order to make it zero. Supplies expense is a debit right now. We're going to credit that account for the same amount to make it zero. Utilities expense has a debit of $230. We're going to credit $230 in order to make the account zero. Salaries expense has a debit, $1,470. We're going to credit that amount to make that zero. We have an interest expense account with a debit of $35. We're going to credit $35 in order to make this account zero. The last expense account is amortization expense. As a $200 debit, we're going to credit $200 in order to make this account zero. When we go to put this information in the journal entry format, you debit the income summary account for the total expenses we're going to close out to zero. And it's easiest to leave that blank until you add up all of the credits. So I'm just going to leave it blank for a second. I'm going to credit the insurance expense, credit rent expense, credit supplies expense, credit utilities expense, credit salaries expense, credit interest expense, and credit amortization expense. So we have all of the expenses listed in our journal entry. We have to add these guys up to give us the total that's going to go in our income summary account. And that total would be $4,085. The explanation for the journal entry would be to close expense accounts. The third step in the closing process is to close that income summary account out to the owner's capital. Remember that the income summary account is a temporary account that has to be zero at the end of the closing process. So basically what we want to do is to take that $2,065, which is our net income, and we want to transfer it down here to the capital account. We do that by making the income summary account zero. Right now it has a credit balance of $2,065, so we're going to credit this account $2,065 in order to make it zero. So we're going to debit the income summary account for $2,065, and we're going to credit capital. So that $2,065 gets put on the credit side of that capital account. The explanation for the journal entry would be to close the income summary account. It's really important that you remember it's the income summary account that you're closing, not the capital account. The capital account is a permanent account, and it's changing, but it's not being closed out to zero. The last step in the closing process is the D in read, and the D stands for draws or withdraws by the owner. We have to close that withdrawal account out to zero, so we're going to take the $600 and we're going to put it up in this capital account. In order to close this temporary withdrawal account, we have to do the opposite of what's in there already. It's a debit now. We're going to credit this account for $600 in order to make it zero. If we credit the withdrawal account, we're going to debit the capital account for the same amount. So our journal entry would be a debit to the capital account for $600 and a credit to the withdrawal account for $600. Explanation for our journal entry: to close the withdrawal account. And remember, again, we're closing the withdrawal account, not the capital account. We're making a change to the capital account, but it's certainly not going to become zero at the end of this fiscal year. Remember that the capital account represents the book value of the company. So at the end of the fiscal year, we want to calculate what the new value of the company would be. So we would add up the debits, add up the credits, and take the difference between the two. And the new balance of the capital account becomes $11,465. Remember that way back in the beginning of this course, we talked about the capital account, and we talked about what went in that capital account. We know that capital goes up, or the book value of the company goes up with investments by the owner, with net income. The value of the company goes down when a company has withdrawals by the owner or a net loss. So this capital account at the end of the year now reflects the new value or the new book value of this company at the end of the year. All journal entries have to be posted to the general ledger, and the closing entries aren't any different. So those closing entries have to be posted to the general ledger. Whenever you change the general ledger, you have to prepare a trial balance to see if the debits equal the credits. This trial balance is called the post-closing trial balance, and it's a list of all the accounts that are not closed out to zero. The only accounts that should have balances remaining are permanent accounts. So when you have a look at the example for Finley Interiors, you'll see that the only accounts left are the permanent accounts. Remember, the permanent accounts are the asset accounts, which are these guys. The liability accounts, which are these ones, and the capital accounts. They're the only accounts in the general ledger that should have balances at the end of the fiscal year.